Okay, everyone, Assalamu alaikum and welcome to today's session. Today is day 4 and we will be discussing the area of framework and the related current issues. So far in day number 1, we had discussed about the area of consolidation. Similarly, in day 2, also we were discussing the consolidation. In day number 3, we have covered the area of analysis and the area of ethics. Now in today's session, we are going to cover the framework and the current issues. Okay, so now let's continue with the importance of framework. This is not important, this is importance. That what is the importance of framework? What is the requirement of framework? Why has the IASB board prepared the framework? So basically, if no conceptual framework existed, then it is more likely that the accounting standards would have been produced on a haphazard basis. So what framework does? Framework provides a basis on which the accounting standards are built. Like for example, prudence concept, matching concept. These are the concepts based on which the accounting standards are basically developed. So if there was no conceptual framework, the accounting standards would have been produced on a haphazard basis as particular issues and circumstances arose. Even if I tell you the treatment of the OCI is still haphazard, because different accounting standards decide on their own that which type of values should go to OCI and which type of value goes to PNL, because there is no area covered by the framework where the framework specifies that what is the difference between the PNL and the OCI and which type of item should be classified in the PNL and which type of item should be classified in the OCI. So, so currently the accounting standards are basically deciding on their own that which type of values should be taken to PNL and which type should be taken to OCI. Like for example, if I talk about IAS 16, the gain in IAS 16 is taken to OCI and the losses in IAS 16 is taken to PNL. But in IFRS 9, both gains and losses in the fair value through OCI category are taken to OCI. So now if we see there is an inconsistency, the loss of 16 is taken to PNL, but the loss of IFRS 9 is taken to OCI. So currently the treatment of the OCI is inconsistent between the accounting standards. The reason behind is that it is not covered in the framework. So if it is introduced in the framework, the accounting standards will automatically be adjusting according to that rule. Similarly, these accounting standards might be inconsistent with one another or perhaps even contradictory. So if the framework would have not been produced, the standards may have been contradictory. Like for example, if I tell you some of the contradictions in the current period, is that the framework says that the outflow liability is recorded when the outflow is probable, and the asset is recorded when the inflow is probable. But IAS 37 says that the asset is recorded when it is virtually certain. And if it's probable, we are not going to record an asset. Instead, we are going to disclose it. Now, this is a contradiction between the framework and the standard. So even despite of making the framework, we have different contradictory standards. We have inconsistency between the standards. So if there would have been no framework, the level of inconsistency and the contradiction would have increased. Further, it also acts as a reference point for the preparers of the financial statement if there's no adequate accounting standard. So in case of any issue where there's no adequate accounting standards, the framework should be referred. Like for example, when there was no IFRS 2, when there was no IFRS 2 back before 2005, people used to have different accounting treatments of the share-based payments. So now as an auditor, how are you going to decide whether the treatment of the company is right or wrong? That should be based on the framework. So framework is basically the basis which on which the standards are developed. So in case of any missing accounting standard, the accountants and the auditors should also refer to the framework. Now further, the importance continues with that the framework helps the standard setters, which means the ISB board, when developing the new standards. And similarly, the importance includes the assistance to the auditors. So we can say that the framework is basically assisting the accountants, assisting the auditors, assisting the ISB board, the accounting, the standard setters, treated as a reference point if no accounting standard is available. So these are all of the points which are the importance of the account of the framework. So if the question asks you that the directors are not aware about the importance of the framework and consider the framework to be a useless thing, so in reply, these are the points that you need to be writing. Murtaza is saying this compliance with framework is equal to the compliance with IFRS or IES. Yes, Murtaza, it is. But for example, if there's a contradiction between an IES and the framework, what we are going to do, we are going to provide preference to the IES. But if a company is in non-compliance of the framework, this is equivalent to the non-compliance of the accounting standard. Although framework is not an accounting standard, but its relevance is still there. Okay, now according to the framework, the first point that we are going to discuss is what is the objective of financial reporting? What is the objective of financial statements? Why do we prepare that? So the objective of financial reporting is to provide information to a wide range of users. Now, who are the users which framework identifies? Is the users are the existing and the potential investors? The existing and the potential investors. If you remember yesterday's question, we had a question where the COO was saying that our objective is to maximize the shareholders' wealth. So, so in reply, we can say that according to the framework, the objective of the financial statements is to provide information to both the existing and the potential shareholders. So in this case, the company which is going to acquire, if you remember that case, there was a company by the name of Old Castle to whom we were going to sell the shares of our subsidiary. So the responsibility of the accountant includes providing the right information to the potential shareholder, not only the existing one. Similarly, the objective is to provide information to the lenders, which mean the loan providers, and other creditors, which means other people who are providing goods or services to us on credit, which helps them when making decisions about providing resources to an entity. So the long-term investors actually includes the equity investors and the debt investors, and the short-term investors includes the creditors. So basically, the main objective is to provide information to the investors to decide about what resources should they be providing to the entity. Now, when we prepare the financial statements, there is an underlying assumption. There is an underlying assumption based on which we prepare the financial statements. The underlying assumption is that the framework identifies the going concern as the underlying assumption governing the preparation of the financial statements. So if the going concern assumption exists, we are going to follow the IFRS. But if the going concern assumption does not exist, we are not going to follow the IFRS. Instead, we will prepare the financial statements at their breakup value. Breakup value means their net realizable value. So going concern is one of the assumptions of preparing the financials as per the IFRS. Murtaza is saying, how is the breakup value determined? Murtaza, breakup value is the net realizable value, which means the fair value less cost to sell. Net realizable value means NRV basically. So expected selling price or the fair value less expected cost to sell, or the fair value as cost to sell. So this is called the breakup value. And when we call breakup value, this means that if we are selling the assets individually, selling the land and the property separately, selling the plant separately, selling the inventory separately, selling all of the assets in a breaked up form, in a distributed form, we are not selling the company as an entire company. Rather, we are selling the assets individually, which in F9 we used to say the asset based valuation. Okay, so now let's move further. What is it that the liabilities are also carried at their net realizable value, which means the value at which they will be settled. Okay, now the next thing that we are going to discuss in the framework is the qualitative characteristics of the financial statements. That the financials should be quantitatively correct and should be qualitatively correct. Quantitatively and qualitatively should be correct. So, what are the qualitative characteristics that the financials should meet? So, we say that there are two types of characteristics, the fundamental characteristics and the enhancing characteristics. The fundamental characteristics and the enhancing characteristics. So, now the fundamental characteristics includes two major characteristics, the relevance and the faithful representation. Two main characteristics are the relevance and the faithful representation. Now, what do we mean by relevance? That the information provided in the financial statements is relevant to the shareholders. The financial the information that we are providing should be relevant if it impacts the decision made by its users. So we should be providing only the relevant information which is going to affect the decision of the user. Yes. So now, if I tell you further about the disclosures of the IFRS, there are some concerns with respect to the disclosures as well, because there are no rules that governs the rules of the disclosures. So what happens that a company provides too much details in the disclosures, due to which what happens is the relevance of the information gets reduced. So the IASB board is working on this, that how can the disclosures be be governed in such a way that every IES basically provides a format of providing the disclosures. So, for example, if we talk about the company's policies or the accounting policies that are disclosed in the financials, we currently disclose all types of policies in a single manner. Policy 1, policy 2, policy 3, policy 4. But does all of these policies have same relevance or not? Obviously not. So the ISB board is working onto this, that the policies which are very important for a user to understand should be classified separately. The policies which may be important to some of them should be separately classified, and the policies which may not be relevant to the user should be separately provided. So this is how the relevance of the financial statements would be improved. So currently, ISB board has been working very strongly to increase the relevance of the financial statements. So this is basically one of the qualitative characteristics of the framework. Meng Hang Sao is saying that to reduce the unnecessary disclosure, we use disclosure initiative in the financial statements. We disclose only relevant policies. Yes, Meng, even the word relevant basically is classifying all of the policies in either relevant or irrelevant. The level of relevance may also change: highly relevant, normal relevant, low relevance. So the ISB board is basically working towards going into more detail of the word relevance, that what thing is relevant and what thing is not relevant should be converted into the levels of relevance. Are you getting the point, Meng? Okay, good enough. So now relevance is basically supported by materiality considerations. So whatever thing is material is going to be relevant for the user. And when we talk about material, again, this should be material quantitatively and qualitatively both. Like for example, an error of 1 rupee and a fraud of 1 rupee or $1. An error of $1 and a fraud of $1, we say that the fraud is material, but the error is immaterial. So every material impact should be disclosed in the financials, whether it is material quantitatively or it is material qualitatively. In both the aspects, it is relevant for the user. Mira is asking, what is the rule of thumb for relevance? Because the company looking for investment may want to disclose many information to attract investors. Basically, Mira, there is no rule of thumb right now. This is on which the standard is working. The ISB board is working that the standards should at least provide the rule of thumb based on which the the disclosures should be decided. Murtaza is saying I didn't get material qualitatively. Murtaza, basically, for example, there's a company A which has discontinued a business. Now, do you think that that discontinuation of a business is material qualitatively? As a shareholder, you do not know that one of the business has been discontinued because it was immaterial. So we say that qualitatively the information should be available to the shareholder if it is relevant to him. So what happens is that few things are not material in terms of amount, but they are important in terms of the knowledge. Yes, Mac is right. Like for example, related party transactions. All related party transactions are material qualitatively. So if we are making a related party transaction of $1, that would be a that would be a material value, and this should be disclosed in the financials. So when deciding what is material and what is not, one should consider both the qualitative and the quantitative aspect. Yes, Mira, we can say that. Now, the first qualitative characteristic that we have discussed was the relevance. The second one is the faithful representation. When we say faithful representation, this means true and fair view. That the financials should reflect the true and fair view. And the true and fair view can be reflected if the financials are complete. So we should not ignore or any transaction which has been occurred during the year. All transactions should be reflected in the financials irrespective of whether they are relevant or not. Like in the last question of Farham, where the question said that there was a factory subsidence and the COO was not willing to disclose that. So basically, the financials that COO is trying to prepare are not complete because there is some information that has been skipped from the financial statements. So faithful representation says that you should be reflecting all of the transactions that have occurred during the year through that the financial statements are going to be complete. Second is the neutral. The word neutral means that neither we should be trying to overstate the profits, nor we should be trying to understate the profits, nor we should be trying to overstate the profits, and nor we should be trying to understate the profits. Yes, Murtaza, there can be called a conflict. Now, basically, what happens is that the concept of neutral actually again conflicts with the prudence concept. If I'm prudent, I will try to understate the profits. And the word neutral says that do not understate the profits. So now there's a concept between the prudence concept and the neutrality concept. So what the ISB board did is actually they removed the prudence concept from the framework. They actually removed the prudence concept from the framework. So the framework that is right now applicable does not have the prudence concept, because this is basically excluded from the framework. So now the framework says that the financial should be neutral and should not be prudent. Although in the current issues we are going to discuss that the prudence concept is going to be reintroduced in the framework, and the reasons why the ISB board has decided to reintroduce will be discussed over there. RD Chaudhary is saying, sir, please explain the prudence concept. RD, prudence concept says that if you have two options, one results in overstatement of the profit and the other results in the understatement of the profit. So the prudence concept says that understate the profits rather than overstating that. So the prudence says that the profits should not be overstated, the assets should not be overstated, the liabilities should not be understated, the losses should not be understated. These are 4 points which are according to the prudence concept. Assets should not be overstated, profits should not be overstated, liabilities should not be understated, losses should not be understated. So these are 4 points that the prudence concept actually defined. But the ISB board thought that there is a conflict between the neutrality and the prudence, that if I am prudent, I cannot be neutral. And if I am neutral, I cannot be prudent. Diana is saying not clear on materiality, if you kindly repeat. Basically, Diana, materiality means anything which can change your decision is material for you. Anything which can change your decision is material for you. Like, for example, if I say that you are crossing a highway and a coin of $1 basically slip off your pocket and drops on the road. You are crossing the highway and $1 of the coin drops off from your pockets. Now, are you going to stop and pick up that coin, or are you going to leave that and cross the road? What do you think? You're crossing a highway and $1 coin slips off your pocket. Are you going to stop, or are you going to continue crossing the road? Diana, what do you think? Diana is saying continue. This means that $1 is not material because it didn't change your decision to stop and pick that coin up. Are you getting the point? Any event that is going to change your decision is called a material event, and any event which is not going to change your decision is called an immaterial event. Yes, Sakib is saying means that something that's important enough to change the decision. Sakib, important enough to change your decision. Harsh is saying very nice example. Thank you, Harsh. Okay, Diana, are you clear with that? Any event which is important enough to change your decision. Okay, let me see one more question. Mira is saying that is prudence similar to conservative. Yes, Mira, exactly. Conservative approach is the prudent approach. Murtaza is saying prudence means to be cautious if doesn't mean to understate profits. Am I right? You can say that, Murtaza, basically, we are not trying to understate the profit, but what if we have only two options? One overstates and one understates. So the prudence says go for understatement of the profits, but not overstate that. Okay, one more question is that what I understand is neutral means to disclose everything with a negative or positive, and prudence means to be cautious. Basically, Murtaza, not disclose, account for. Neutral means reflect in the financials what is positive and what is negative both, rather than focusing on the negative and ignoring the positive, or rather than focusing on the positive and ignoring the negative. So neutral concepts means that be natural. What is happening? Tell that whether it's good or whether it's bad. You have to tell the people. Yes, Mira is right that neutral means as it is. Tell people what actually is rather than try to window dress that. Window dressing means showing something else and being something else. So neutral concept says be natural, show what you are, do not try to window dress things. The third point is that the financials are going to be faithful if they are free from any material error. They are free from any material error. So for example, if during the year we find out that last year there was some error and that needs to be corrected. Now, should we correct that retrospectively or should we correct that prospectively? If in the current year we find that there was an error in the previous year, should we correct that prospectively or retrospectively? Okay, everyone is saying retrospectively, Murtaza is saying prospectively. The answer is yes, retrospectively, if it's material. Retrospectively, the correct answer is retrospectively if it is material, and if it's not, then prospectively. Because IS 8 says that you should be retrospectively treating all of the material errors. We should be treating retrospectively all of the material errors. So if the error is material, then you should be treating that retrospectively. Otherwise, treat that prospectively. So the financials should be free from all material errors. But one thing that we have to remember is that, for example, if the company makes an intentional error, if the company makes an intentional error because it's immaterial, if the company makes an intentional error, intentionally making an error, and says the amount is immaterial, so is this right, allowed, or wrong? If the company is making immaterial intentional error, everyone is saying wrong. Why? The answer is right, it is wrong, but why? Yes, exactly. Because the intentional error means fraud. The intentional error means misguiding the people. The intentional error means that you are trying to show a different picture that which is not neutral. So if the error is an intentional error, we are going to say that intentional error is material qualitatively. I don't know why the slides are changing on its own. The intentional error is basically material qualitatively. So if a company is trying to make an error in saying that that's immaterial, we're going to say that is immaterial, but it does not mean that you make intentional errors. Okay, so now we have discussed the fundamental characteristics which are defined in the framework. I'm actually taking the topic into more detail because I think a lot of people have no knowledge or very less knowledge of the framework. So that is why I'm taking the topic into comparatively more detail. Mohammed Saad is saying the treatment should be retrospectively. Yes, Saad. It is by nature of the transaction. Exactly, Abid. So now we have covered the fundamental characteristics. What are the fundamental characteristics? There are two. One is relevance, one is faithful representation. Tell all of the information which is relevant and hide all of the information which is irrelevant. Relevant means material, material means which can change your decision. Second is the faithful representation, which means that the financial should show a true and fair view, show how what it is. Don't try to window dress things. Show the complete financials, which should be free from any error. With errors can be material, quantitatively material, qualitatively material. Okay, Muhammad Rayan is saying prospectively and retrospectively. What does this mean, Muhammad Rayan? I didn't get your point. Yes, Murtaza, we will be discussing the revised framework as part of current issues. Now there's one more type of characteristics which is called the enhancing characteristics. This will enhance the financial statements. So now what are the enhancing characteristics? The first is the comparability, that the financial statement should be comparable with their own last year and with the industry, with the same sector. So when we are preparing the financial statements, the financials should be comparable with both the industry and the last year of the company. So based on this point, we say that if a company changes its accounting policy, it should change the policy retrospectively, which means that it should change the financials of the previous year as well, rather than just changing the policy during the current year. So if we are changing the accounting policy, we should apply that retrospectively, which means changing the policy in the previous year as well. And the prospective means do not change the previous year, only change the current year. Etazaz Shah is asking that, sorry, first time using webinar, is this a chat tab? Yes, Etazaz Shah, this is the tab where you can basically chat with me. So you will be chatting by typing and I will be replying on the voice. Okay. Now the second enhancing characteristic is the verifiability. Verifiability means that the financials should be prepared in such a manner that they are easily verifiable by the auditor. Murtaza is saying why enhancing characteristics are not stated in the fundamental. Basically, Murtaza, the relevance of these are comparatively lower as compared to the fundamental one. These should be met by every company. These should be met by every company. But enhancing means that if a company cannot ensure comparability with the industry, that's not an issue. That's preferable. But if that is not met, we are not going to say that the financials are incorrect. But if the fundamental characteristics are not met, we are going to say that the financials have serious problems. So the difference is basically the level of importance that we have to give to the characteristics. The third is timeliness. Timeliness means that the financial information should be provided to the user in a timely manner rather than providing them at a later point of time. So for example, if a company has a year end of 31st December 2017 and it publishes its financials in November 2018, so we are going to say that the financials have not been provided to the user in a timely manner, because that is being provided approximately a year late. So the information should be provided to the user on a in a timely manner. This is what is called another timeliness enhancing characteristic. But if there's some problem and due to some problem we are not able to provide them in a timely manner, that's not an issue. So these are enhancing characteristics. They should be there, but if they are not there, that's not a very big problem. And the last point is that they should be understandable to the user. They should be understandable to the user. Which user? This means that a user who has some basic accounting knowledge. This should be understandable to the users who have some basic accounting knowledge, not exactly to everyone. Yes, Murtaza, you're right. Yes, exactly. Meng Heng, you are also right. Okay, so these four characteristics should be there, and these two characteristics must be there. These must be followed, these should be followed. Now, there's a note at the end. It is important that the cost incurred in reporting financial information are justified by benefits that the information brings to its users. So basically, this point is again relevant to the materiality, that when we are disclosing or providing any information in the financials, the benefit to the user should be more in terms of as compared to the cost. Like for example, if the benefit is of $10 and we are incurring a cost of $15, so it's better not to incur the cost and to ignore the amount. So so the financial information that we are providing should justify that the user's benefit is more as compared to the cost. Yes, Abid, cost benefit analysis. Now the next slide is the elements in the financial statements. That when we talk about elements in the financial statements, there are five elements: assets, liabilities, equities, income, and expenses. These two are taken to the statement of comprehensive income, and these three are taken to the statement of financial position. So the framework actually defines that there are five elements and what are the definitions of those elements. So according to the framework, there are five elements of the financial statements, where the asset means resources controlled by an entity from a past event that will lead to a probable inflow of economic benefit. That will lead to a probable inflow of economic benefit. Now, if you see according to the framework, the asset means probable benefit. But in IAS 37, we say that probable inflow should be disclosed and not recorded as an asset. So, so there's a conflict between the framework and the accounting standard. Similarly, when we talk about the consolidated financial statements, we recognize even the contingent liability of a subsidiary in the financials, in the group financials. Now, the contingent liability is basically something below 50%. So when it's below 50%, the chances are possible. Then why are we recording in accordance with IFRS 3? This means that there's a conflict between the IFRS 3 and the framework as well. No, Osman, we cannot call that an example of prudence. Basically, this is a conflict based on which the IESB board has provided some revised definitions of these elements. So basically, the current framework is contradictory with the accounting standards. Now, whether the standards are wrong or whether the framework is wrong, so the IESB board decided that the definitions are basically requiring some more changes or more details. So, so that is why we are going to discuss a revised framework after this one as a part of the current issues. So what is an asset? Asset is something which is controlled by the entity, one thing, as a result of past event, second thing, and provides probable economic benefit, the third thing. If these 3 points meet, we are going to call this an asset. Yes, Murtaza. The second point is the liability. Liability is an obligation to an entity. Liability is an obligation to an entity arising from a past event that will lead to a probable outflow of economic resources. So basically, the first point in the definition of a liability is that it is an obligation, which may be a legal obligation and which may be a constructive obligation. Second is that it also arises from the past event, and third is that it will result in a probable outflow. So if these 3 points are met, we're going to call this a liability. And equity is the residual net assets of an entity after deducting all of its liabilities. So we can call that equity is basically a type of a balancing figure. Total assets minus total liabilities is going to be the equity of the company. So the equity does not have its own definition. Rather the it is the balancing figure. Now, what is an income? Income is the increase in economic benefit, and expense is the decrease in economic benefit during the accounting period. So these are the 5 definitions which have been provided according to the current framework. Is that clear to everyone? Mohammad Saad is saying, hasn't the asset and the liability definition changed? Mohammad Saad, they have been proposed to be changed. They have not been changed. I'm correcting your statement. Currently, these are the definitions which are applicable, and the ISB board has proposed some changes in the definition which are a part of current issues. Are you getting this point, Mohammad Saad? Meng Hong is saying, I saw the examiner tested about exposure drafts. Where I can find those exposure drafts? Basically, Meng Hong, you can find those exposure drafts in the study text, obviously. Murtaza, we are going to discuss this in the revised area. Now, the next thing that the framework discusses is the recognition and measurement. That how should the assets and the liabilities be recognized and how should they be measured? So, as per framework, an item should be recognized in the financial statements if it meets the definition of an element. So, this is basically the recognition criteria defined in the framework, that it should be recognized if it meets the definition of an element, if it is probable that future economic benefit will flow to the entity. Now, if you see, this point is already repeating. If it's meeting the definition of an asset or a liability, it would obviously be probable already. So there was no need of this second bullet in the framework, but currently it is there, so we need to study that. And the item can be measured reliably. The value of the item can be measured reliably. Harsh is saying, where in the study text can we find? Basically, Harsh, I will share on the group about the chapters where you can find the exposure drafts. Now, these 3 criteria should be met in order to for the element, the asset, the liability, or the income or expense should be recognized. Etazaz Shai Singh, Kaplan, page number 8. Okay, so now these were the criteria, the recognition criteria. Now we are going to discuss the measurement basis. So there are 4 measurement bases which have been defined in the framework. First is the historical cost, that the asset should be measured at its cost less depreciation, which is also known as the cost model in different accounting standards like IS 16, IS 40, IS 38. We call this the historical cost. Mohammad Ryan is saying these definitions are in accordance with 1989 or exposure draft. Basically, Mohammad Ryan, these are relevant to the framework, not the exposure draft. The exposure draft has different recognition and measurement criteria. Now, the second value is the current cost. The current cost means basically the fair value. So the accounting standards can value the assets at historical cost. The standards can value the asset at their fair value. And third is the realizable value, which means the NRV, which is followed by only one IAS, which is IAS 2. And last is the present value, like for example, financial assets, financial liabilities, long-term provisions. These are the values which we record at their present values. So according to the framework, these four measurement methods can be followed. Murtaza is saying the drafts are not final. Basically, Murtaza, there are two types of draft, one which has been closed and one which is open. The open drafts are open for discussion and there can be the changes and the changes are possible. But the closed drafts are still drafts, but they are closed and they are not going to change. So there are both type of drafts. Now we are going to discuss the proposed solution, which is the exposure draft. The exposure draft has made some changes in the objectives and the qualitative characteristics. So in the exposure draft, the board proposes to amend the framework in order to, why are we changing the framework? In order to reintroduce the concept of prudence. As we have discussed previously that the prudence concept was removed because the board thought that it is contradictory with the relevance, with the neutrality, sorry. So now, according to the proposed framework, we are going to reintroduce the prudence concept, the exercise of caution when making the judgments, and to stress its importance in relation to faithful representation of the financial information. So the prudence concept is going to be reintroduced. Basically, Mira, do not think that what is the deadline. From the SBR's paper point of view, we should be aware that what the exposure draft says rather than from when it's applicable, when is the deadline, when it is going to change. So these are the points which are not relevant to the exam. Okay, now with respect to the definition of the assets and the liabilities, there are some further changes. The exposure draft proposes the following definitions. So these are the new definitions as per the framework, uh, as per the exposure draft. That in the definition of the assets, we say that asset is a present economic resource controlled by the entity. So controlled by the entity is the same. And the word economic has basically added in the framework. We say that asset is a resource, but now we are saying asset is a present resource. So this word has been added to the definition. So this is new. Resource controlled by the entity is the same. As a result of past events is the same. Now, if we see the word probable, the probable inflow has now been excluded. Why is that so? Because some of the accounting standards they basically recognize the asset despite it not being probable. Like for example, by acquiring a subsidiary as per IFRS 3, subsidiaries contingent assets and contingent liabilities at acquisition should actually be recorded in the financials, group financial statements. So although the inflow is not probable, but still we are recognizing the asset. So the previous definition of the framework where we say that it should be probable basically contradicts IFRS 3. Similarly, in case of IAS 37, where we have an uncertain inflow, we recognize the asset when it's virtually certain. And if it's probable, we do not record it, rather we disclose it. So there were two contradictions of the definition of the asset with the framework, the relevant IAS. So IFRS 3 was conflicting with the definition and IAS 37 was conflicting with the definition. So rather than changing the IASB board decided that the standards are right and the framework needs changes. Anwar Karim is saying when probable we make provision. Basically, Anwar Karim, when the outflow is probable, we make a provision. But when the inflow is probable, we actually disclose that. Murtaza, these are few examples where basically the definition was contradicting. There may be some other areas as well, which would have been reported by different people to the IASB board. Now, similarly, there's a change in the definition of the liability as well, that it is a present obligation. This is the same of an entity to transfer an economic resource. Again, the economic word has been added as a result of past event. So again, the word probable has been removed from the definitions of the asset and liability. Now, what is an economic resource? Economic resource is a right that has the potential of producing the economic benefit. So this is something which has been added in the definition, that resource is not something which is going to provide benefit. Resource is something which has the potential of providing benefit, irrespective of whether it has a benefit or not. Mohammed Saad is saying, sir, do we have to memorize these definitions for exams? Yes, Mohammed Saad, these definitions are to be memorized, the old one and the new one, because this is a change in the definition. This is a change in the wording. So we should be memorizing the wordings. Otherwise, we would not be able to actually define what was the change. So all the definitions must be memorized very well. Now the last point is the equity. Okay, Mira is saying, do we need to memorize it verbatim? Mira, it's preferable if you memorize it word by word. But if you are not able to memorize that word by word, writing that down the key points would be sufficient. But there are some key wordings like the word economic. You should memorize that by word by word. Similarly, the not the entire definition, but the things which have been added and which have been removed should be remembered properly. Now, what is an equity? These def Okay, the equity of the definition of equity is actually the same, and this is a separate point which should have been on the next line. These differ from current definition of assets and liabilities, which state that inflow and outflow of economic benefits should be probable. So this was the change in the definitions, which is very, very, very important. You should learn this very well so that if it is asked in the paper, you can apply that in the scenario. Murtaza is saying in liabilities there is an exclusion of the term outflow also. Why? And included transfer. Why? Basically, Murtaza, the word outflow means giving cash, and the word transfer means maybe we transfer the liability to someone else and we do not pay him cash. Instead, we transfer another asset. So that may not result in an outflow, or we may provide them shares. So giving shares is basically not an outflow of economic resources. So that is why the word outflow has been replaced by the word transfer. Getting the point, Murtaza? The word outflow has been changed to transfer because not in every case we provide cash or the assets. We may provide shares to them. Now there are some more proposed solutions in the recognition criteria, and the de-recognition is something which was not there in the existing framework. The existing framework was not talking about the de-recognition of the financials, rather it was only talking about the recognition. So this is something which is introduced new in the proposed framework. Now, what are the new recognition criterias? The new recognition criteria is that it is proposed that the element would be recognized if the recognition provides a relevant information, a faithful information, which are basically meeting the fundamental characteristics, which means that these should meet the fundamental characteristics and benefits to the users of the financial information that outweighs the cost of the preparation. So if anything is being produced in the financials, but the cost of producing it is more, does not meet the recognition criteria. Like for example, currently a lot of companies, what they do is they have a lot of companies currently what they do is that they have a capitalization threshold. They have a capitalization threshold that they are going to capitalize any asset which is above, let's say, $1,000. Now, this is the capitalization criteria. So if a company acquires an asset of $500, what they do is they actually expense that out. Now, if they are purchasing an asset and they know that it is an asset, but they are still expensing it out, this becomes an intentional error. This actually becomes an intentional error. And if this is an intentional error, this is material and the standard is not going to allow that. So a lot of companies they actually do this. And why do they do this? Because recognizing an asset of $500 and then estimating its life and then depreciating and then impairment testing in case of any indication will cost the company more as compared to the benefit of recognizing the asset. So previously the treatment was not consistent with the framework and with the IES. But now the framework has introduced a point that a company should recognize the asset or the liability if that information outweighs the cost. So according to this rule, that this the current treatment is going to be correct, which means intentional errors with the motive of recognizing a value which has more benefit than the cost is correct. So this is why this point has been introduced in the framework, proposed framework, sorry. Now the next thing which has been introduced is the de-recognition criteria. Now what is the de-recognition criteria? The existing framework does not address de-recognition. So the exposure draft has provided guidance to ensure that entity provides a faithful representation of the assets or liabilities retained after the transaction. So if any transaction basically eliminates, if any transaction is any disposal is basically making the transaction to transfer the benefits should be de-recognized. So if we have disposed of an asset but still we have retained some part of that, so we are going to recognize that if its recognition provides the relevant information and if the recognition provides the faithful representation. So basically de-recognition is doing nothing rather than referring to the recognition criteria is back. Mohammed Saad is saying this, does the material criteria takes precedence in this scenario? Basically, yes, it takes, but the standard has the proposal has said that that the company should also see that the cost that the company is incurring and the benefit that the company is getting should also be checked. If the cost of the benefit, if the cost of the recognizing is more than the benefit, then the company should not recognize the transaction. Yes, Mohammed Saad, we can say that. Now, the next thing that we are going to discuss is the measurement methods which have been changed. Previously, there were four measurement methods: the historical cost, the current value, which was the fair value, the the current cost, which was the fair value, the realizable value, and the last one was the present value. But now the exposure draft has outlined two broad ways of measuring the elements. One is the historical cost and one is the current value. Now, if we see, the current cost has changed to current value because all of these three values are all current values. So basically, the proposed framework has the same measurement methods but with different workings, but with different wording. Sorry. So even now, there are four measurement methods of historical cost, current cost, realizable value, and the present value, but we call all of these together as the current values. That is why we say two broad ways. These are not two total ways. Total ways are still four, but broadly we say that there are two methods of measuring the asset or the liability. Murtaza is saying, what if the benefit versus cost is low, but info is relevant and adds to the faithful representation? Can we ignore fundamental characteristics? No, Murtaza, we cannot ignore the fundamental characteristics in any case. So if anything which is relevant, it cannot be that the benefit is lower than the cost, and but still it is relevant. Anything which is relevant has a more benefit than the cost, and we should be recognizing that in the financials. The exposure draft proposes guidance on the factors to consider when selecting a measurement basis. So this was all about the area of framework and its proposed changes. Now, the next area that we're going to discuss is also a proposed amendment to IFRS 3 and IFRS 11, which basically relates to the definition of a business and accounting for previously held in trust in the joint arrangements. Now, the exposure draft proposes amendments to IFRS 3 and IFRS 11 to clarify one thing that we need to know, that this is only a clarification. The definition of a business, that what is a business. An acquisition must include, at a minimum, an input, a substantive process that together contributes to the ability to create outputs. This means that business means inputs less ability to generate outputs. This is the new definition proposed in the exposure draft. Now, what was the old definition of a business? The old definition was that a business is treated as a business if it has an input plus it has a process plus it has an output. If all these three things are there in a business, only then we treat that as a business. This is the old definition, but the new one says that it is not necessary to have a process and an output, but it should have the ability to generate output, ability to generate the processes and develop the output. So basically the process and output are converted into the ability. Yes, exactly. So the second point is that the accounting for previously held in trust in assets and liabilities of a joint operation in transaction in which an investor obtains control or joint control of a joint operation that meets the definition of a business. Now you cannot understand these wordings of the standard. This says that, for example, if we have a joint venture or an associate or a simple investment and we actually acquire more shares and gain control of the company, then this is treated as a step acquisition under IFRS 3. If we have a joint venture or an associate or an investment and we acquire more shares and gain the control, that is basically IFRS 3, a business combination. But what if, we had a joint operation? But what if we had a joint operation and now we have gained control of the subsidiary? Do you understand what is meant by a joint operation? Do you know that? This is as per IFRS 11. What is the difference between joint venture and a joint operation? Okay. Murtaza is saying no, please clarify more. Mengong is saying joint venture is equals to unanimous consent. Harsh is saying consolidate 50% in joint operation. I think consensus. Okay. Different people are saying different wordings, but none of them are correct. Basically, let me explain you this point that when we talk about IFRS 11, IFRS 11 relates to a joint arrangement. And joint arrangement means joint control. And joint control means unanimous consent. Now, what do we mean by unanimous consent? What do we mean by unanimous consent? Yes, basically, all of you know about this. That unanimous consent means where multiple parties have to agree on a single decision. So this is called a unanimous consent, a joint control. Now, if A and B have a joint control over C, have a joint control over an entity C, we call this to be a joint venture. So joint arrangements are of two types. Either it is going to be a joint venture or it is going to be a joint operation. Now the difference between these is that joint venture is a jointly controlled net assets and joint operation is a jointly controlled assets or liabilities. So if A and B jointly control a company C, that is a joint venture. If A and B jointly controls an asset, they have a jointly controlled building, let's say. This means that this is a joint operation. So there is no separate legal entity in case of a joint operation. We just have a joint control over another asset or over another group of assets. So this is called joint operation. Now, joint venture is basically something which is going under IFRS 3. This is a business. But is a joint operation a business or not? This is a question. Is joint operation a business or not? This is a question. Because if we convert this joint operation into a subsidiary, will that be a case of piecemeal or not? This is something which the exposure draft is going to cover. So now the exposure draft has basically said that joint operation is a business, because although it is not a separate legal entity, but it can be made a separate legal entity. So it has the ability of generating the outputs. It has the ability to make such processes to generate the outputs. So that is why we say that joint venture is also a business as per IFRS 3. So according to the exposure draft, we are going to classify the joint operations as a business as well. But before this exposure draft, joint operations were used to be called other than a business. That was not called a business, that was called a simple asset or a liability. Okay, thank you, Murtaza. Simran is saying, can you give a more detailed example? I'm still confused with the difference. Okay, Simran, let me give you an example for that. Let's suppose that A and B are two individuals, and A has a shop in a market, and B has some, let's suppose, um mobile phones, a lot of mobile phones B has. Now, A and B, once they met and they decided to start a business of a mobile phone shop. A and B decided to start a business of a mobile phone shop. Now, what they did is basically they made a company C where A brought the shop and B brought the mobile phones. And they started the business under C Private Limited. So now, is this a joint arrangement? Is this a joint venture or a joint operation? They've started the business by the name of C Private Limited. So is this a joint operation or a joint venture? What was I saying? Joint venture. Mira is saying joint venture. Hassan is saying joint venture. Simran is saying joint operations. No, Simran, this is a joint venture, because what if there's a dispute between A and B? What will happen? If there's a dispute between A and B, what will happen is that they are going to sell the company C, or they are going to sell the shop in the market and sell the phones and then distribute the cash between A and B. So we are going to call this a joint venture. But if A and B did not register the company C, but what they did, A brought his shop and B brought the phones, and they actually gave a name of A and B, and they started a business without registering a separate legal entity. Now, if there's a dispute, A will take his shop, B will take his phones. So this means this is a case of joint operations. So where net assets are going to divide, we call this a joint venture. And where the assets and liabilities will be divided separately, we call this a joint operation. Okay, Simran has got the point. Most welcome, Simran. So now if I go back to the presentation where we were discussing the amendments, So now the definition of the business has actually changed, and the accounting where the interest was held in assets and liabilities of a joint operation is something where there are certain changes. So now we should be moving towards the past papers, but what we can do is we can take a break first and then we can continue. So we are taking a break of 15 minutes and then we will be continuing with the presentation. Okay, everyone, welcome back and let's continue the session. And now we have discussed about the framework and have discussed about some of the current issues, and now we'll be solving some of the past paper questions. A few students have been asking to solve December attempt question because that included a lot of framework areas. In fact, three different questions had included the framework area. So we will be covering the September and the December exam questions. So let me start from the September exam question. September and December questions and the answers have been uploaded in the handouts. So you people can download from over there. Simran is saying, sir, by any chance there will be any class tomorrow? No, Simran, today is going to be the last session of the webinar because it was a 4-day session, and you can request the ACCA to extend the webinar, obviously, but nothing is in my control. So I was advised to have a 4-hour session, a 4-day session. So let's continue with the session. Okay. Simran is saying how to request ECCA. Simran, you can send an email to them. I don't know what is the email address to on to which you should be sending, but I think admin could reply to you on that. Okay, so now we are starting the September exam paper. In this, basically, in question number one, there was some part relating to the framework. Mohammad Ryan is saying, can you please explain concept of capital and capital maintenance? Mohammad Ryan, let's focus on the framework right now so that at least we can complete this area, because frameworks questions are very important and they are very easy, in fact. But once we are aware of how to solve that, it will help us pretty much. So approximately you should be expecting around 10 marks of the framework question. So now in this, the part B basically relates to the area of framework, where the question is saying discuss whether the directors are correct to treat Melon as a financial asset acquisition, and whether the International Accounting Standard Board's proposed amendment to the definition of a business would revise your conclusion. So this is a 7 marks question. Just give me a minute. Okay, so the question was saying that discuss whether the directors are correct to treat Melon as a financial asset, and whether and means that we have to break the requirement from over here, and whether the International Accounting Standards Board's proposed amendment to the definition of a business would revise your conclusion. So let's move towards the question where the question was talking about this, the acquisition of Melon. So now we are reading this. So the question is saying that on 30th June 2007, Banana acquired all of the shares of Melon. So Banana is a company who is acquiring all of the shares of Melon, an entity which operates in the biotechnology industry. Melon was only recently formed and its only assets consists of a license to carry out research activities. So its only asset is a license to carry out the research activities. Mellon has no employees as research activities were outsourced to other companies. So Mellon has no employees and the research has been outsourced to other companies. The activities are still at a very early stage and it is not clear that any definitive product would result from the activities. So the activities are at a very basic stage. So that is why we are not sure whether we would have any benefit from these license or this is going to be a simply loss. A management company provides personnel to Mellon to supply supervisory activities and administrative functions. Banana believes that Mellon does not constitute a business in accordance with IFRS 3 since it does not have any employees nor carry out any of its own processes. So, as per the current definition of the business, is Mellon right or wrong? According to the current definition, is Mellon saying right or wrong that it is not a business as per the current definition? Patrick is saying right, Murtaza is saying right, Harsh is saying wrong, Saad is saying yes, Hassan is saying wrong, Musharif is saying right. Yes, basically, as per the current rule, it is right. But as per the exposure draft, this treatment would change. So according to the current IFRS 3, this is not a business combination. Banana intends to employ its own staff to operate Melon rather than to continue to use the services of the management company. The directors of Banana therefore believe that Melon should be treated as an asset acquisition but are uncertain as to whether the International Accounting Standards Board's exposure draft definition of a business and accounting for previously held in trusts ED 2016/1 would revise your conclusion. Okay, Simran is saying no audio, sir. Can everyone else hear me properly? Mohammed yes, 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 yes. So this means Simran, there's some problem at your side. Now, let's write down the answer in a Word file. So we are writing the answer to Melon, which is September 2018, question number 1, part B. So we are going to write that according to IFRS 3 or as per IFRS 3, as per the current IFRS 3, an entity constitutes to be a business if it has inputs, processes, employees to process the function, and generates outputs. So this is the current definition as per the IFRS 3. Now, Mohammad Saad is saying, can you also define the template to answer such questions, sir? Mohammad Saad, the template is pretty similar to Section B standards. First, define the rule and then apply it. Define the rule and then apply it. So we have defined the rule. Now we are going to apply that in case of banana or in case of melon, we can see directly it has only a license to carry out research activities and currently has no employees or the processes, and the research have been outsourced to other companies. Further, the Further, the activities are at a very early stage and it is not definitive that it would result in any sort of um, output. Therefore, the criterias of considering an entity as a business are not met. Therefore, banana is correct to treat this investment as a financial asset, or we can say as an asset rather than a business. So now up till here we have defined what is according to the current IES. Now we'll be writing according to the exposure draft, and then we'll be talking about the um, applying onto the scenario again. Meena is saying, sir, so in the answering we have to define the rule, apply to the case specific and conclude. Yes, exactly, Meena. This is what is the correct way. Define the rule, apply to the scenario, conclude that. Now I'm going to say that according to the exposure draft, the definition of a business has been more clarified by the IASB board, where an entity should have inputs and the ability to generate processes for output, and there is no requirement with respect to the employees, as internal employees or external employees play the same role. So previously the standard said that there should be employees to process the function, but if we are outsourcing this work, there cannot be the employees. Okay, so in case of Melon, the license that it has is an input using which the entity can generate products, which will be the processes and will generate the outputs. Therefore, Melon has the ability to generate outputs and shall be treated as a business as per the exposure draft. So this was basically the first question that we have solved relating to the framework of 7 marks. So any questions in this, then we'll be moving towards December 2018 attempts questions of the framework. Okay, Simran is saying no audio. Simran, because I'm quiet right now, waiting for you people to ask your questions. That is why there's no voice. Okay, Murtaza is saying, is there anything other than the license? Murtaza, in terms of inputs, there is nothing other than the license. The license is the only input that Melon actually has. Okay, now I am opening the December 2018 exam, and let's read the questions in this. Again, in December, also the question had a part D relating to the framework. So in both September and December, the area of framework has been asked in the question number 1. Mohammed Saad is saying, how can it generate output when they are not probable? How can it generate output when they are not probable? Mohammed Saad, basically, we are not saying that they can generate output. We are saying that they have the ability that they can generate output. They will or not, we do not know, but they have the ability to generate an output. So based on that, we are saying that it is um, meeting the definition of the asset. Okay, Simran is saying, so can you explain how employees have same role means what, sir? Basically, Simran, let's suppose I have a company and I have hired 4 people to work in the company. So that is one case where I have my own employees. And the second case is that I feel that my employees are not working good enough. So I basically fire them and instead I outsource this work to a company who hires some 4 employees and does the work for me. So for me, isn't it the same getting the work from my own 4 employees or getting it outsourced to someone else and get the employees being hired from them? Because I want the work to be done, irrespective of who is doing that. So carrying the work in-house and making the work outsourced is actually going to provide the company the same benefit. Are you getting the point, Simran? Getting the work done by our own employees or getting the done by someone else's employees is the same. But the previous definition used to say that the company should be in-house. And now we say it is not necessary for the employees to be in-house. Okay, Simran has got the point. So now let's see a 6 marks question relating to the framework. The question requirement says explain how the probability um, criterion has not applied consistently across the accounting standards. So basically, the question is talking about the definition of the asset and the liability, that the word probable has been removed from that. So the question is saying that how does this have been applied inconsistently across different standards? Illustrate your answer with reference to how there may be inconsistencies with measurement of assets held for sale, provisions, and contingent considerations. So the examiner has actually provided you the detailed guidance on what are the inconsistencies in the definition. Your answer should also discuss how the board's proposed changes to the recognition criteria address the issue. So the question is talking about both the existing criterias, the conflicts that they have, and how they are going to be solved according to the proposed framework. Now let's read from the first line. The 2010 version of the conceptual framework for financial reporting, which is known as the conceptual framework of the International Accounting Standard Boards, the board specifies that it must be probable that any future economic benefit associated with the asset or the liability will flow to or from an entity in order for the asset or liability to qualify for recognition. So yes, okay, Murtaza is saying that please illustrate held for sale in detail. Yes, Murtaza, I will be writing the answer completely in detail. Now the question says that currently accounting standards have been criticized for not necessarily applying the probability criterion relating to future economic benefit on a consistent basis. The board issued Exposure Draft 2015/3 Conceptual Framework for Financial Reporting, in which new recognition criteria were proposed to address this issue. So now let's read the question again. Explain how the probability criterion has not been applied consistently. So we are writing December 2018, question number 1 by the name of what? Moise. And this is part number B that we're going to solve. Now we're going to say that as per the current framework, an asset or a liability is recognized if the cash flows are probable. But when we talk about the first thing the question had said about held for sale, but when we talk about IFRS 5, where an asset is treated held for sale if the sale is highly probable. IFRS says that you're going to treat the transaction as held for sale if it is highly probable, which contradicts with the framework, with the definition of the framework, as the word highly is not there in the definition of the framework. So this is how there's an inconsistency in case of IFRS 5. Basically, the word probable means more than 50%, and the word highly probable means more than 75%. The word probable means more than 50%, and highly probable means more than 75%. So this is the first case where we have talked about the IFRS 5, which the question required. The second requirement was the provisions, and the third was the contingent considerations. Now we're going to say in as per IES 37, an outflow is recorded as a provision if the chances of outflow are probable, which meets the definition of the framework. But in case of an inflow, if the cash flow is probable, IES 37 requires the entity to disclose that transaction rather than recognizing it. And instead, the asset is recognized if the chances of inflow are virtually certain, which contradicts or which conflicts with the definition of the framework. So we have talked about two different parts right now. Someone is saying, sir, you just said that 75% is highly probable. So why you said framework doesn't define highly probable? Basically, Simran, when we say probable means more than 50%, possible means less than 50%, remote means less than 5%, virtually certain means more than 95%, highly probable means more than 75%. So these percentages have not been defined in any standard or the framework. These are the general practical practices that are being followed. So according to the framework and the standard, there are no percentages defined anywhere. Basically, we have already written that this contradicts with the framework. In the first point, that according to IFRS 5, the asset is recorded if it is highly probable, which is not there in the definition of framework. So this actually contradicts, Simran. We have already written that the word highly probable contradicts with the framework. And Murtaza is saying that the question is talking about contingent liabilities and not the provision. Uh, no, Murtaza. The question is talking about both the provisions and the contingent consideration. Contingent consideration is the one that is there in IFRS 3. So the question has talked about IFRS 5 provisions and then the contingent considerations. Okay, Simran is saying, I mean IS 37, not IFRS 5. Basically, Simran, there's no word of highly probable in IS 37. IS 37 says virtually certain, which means more than 95%. 37 says that the asset should be recorded when it's virtually certain. The word highly probable is not there in IS 37. Now let's write about the contingent consideration. We're going to say as per IFRS 3, when acquiring a subsidiary, all contingent considerations are recognized in the financial statements irrespective of the chances of outflow, which means even if the chances are remote, the consideration is recorded in the financial statements, which again contradicts with the definition of the framework where the outflow should be recorded as a liability if the outflow is probable. Okay, so this is how we have completed the first part of the question where we have identified how the definition, how the existing definition contradicts with the definition of the framework. Now we're going to discuss that your answer should also discuss how the board's proposed changes to the recognition criteria address the issue. So now we're going to write that about the new definition, what it is, and how it actually resolves the issue. Okay, so we have a question. Simran is saying that, sir, how can we know what the board proposed? Basically, Simran, we have just discussed the proposed framework. That is what the board has proposed actually. We have discussed the proposed framework today. So that is what is being proposed by the board. So we are going to write that. Yes, Simran, that was before the break. Harsh is saying, so don't we need to explain the requirement of the framework to show how it conflicts with the framework? Harsh, we have the definition we have started with it. That what is the existing definition of the framework? Murtaza is saying, sir, I think highly probable may not have been defined clearly as 75% plus in the standard. Yes, Murtaza, the highly probable word has no percentage other than the general practice that we follow in the practical world. Okay, so now let's write the second part of the answer. As per the proposed changes in the framework, the board has provided a new definition of the assets and the liabilities and have provided new criterias for the recognition. which are as follows. So now we are going to write the new criteria, which is that more relevant information is provided and more faithful presentation is given, and the benefit of recognition exceeds the cost. So this is the new definition according to which the asset and the liability are going to be recognized. Now we are going to mention that a key change in the definition is the removal of the probable criterion, which was contradicting with different accounting standards. So to ensure consistency, the board has proposed to make the change. So this is how we are going to complete our answer, mentioning what was the cost and mentioning what was the definition and what was the core change in the definition. Okay, yes, Simran, we have discussed the exposure draft before the break. So I think you have missed that. You can cover that from the recorded lecture, which will be available from tomorrow. Mohammad Rayan is saying, sir, should we memorize or learn all EDs and proposed changes? Mohammad Rayan, you should understand the changes, you should understand the concepts, but the definitions and the criteria should be learned by heart. The criteria and the definitions should be learned by heart. Simran, these three bullets we have studied in the exposure draft, so you have to refer to that. So now we are done with the first question relating to December 2018 framework. Now let's move down. And in the third question, part A, the examiner again asked about the framework, and in part C, it again asked about the framework. So three different questions were there in December attempt, which were relating to the framework. Musharraf is asking, don't we need to provide new definition of the asset or the liability? Basically, Musharraf, the main change is in the recognition criteria. So covering that will be enough. But if you want to write the definition of the asset and the liability, you can write, obviously. Merullah is asking, sir, is there any other current issue apart from IFRS 3 and IFRS 11? Yes, Merullah, there are small other points as well. One was relating to the materiality. One was relating to the APMs that we have already covered in yesterday's session. So these are the major exposure drafts. Simran, you can learn all of the exposure drafts from the study text, obviously, because we don't have enough time to cover everything. The objective of the webinar was to ensure that the students are able to know how the questions are to be attempted. So so that is why I have covered the important areas, and now we have moved towards the exam questions. Because if I would have not taught the framework and I would have jumped directly to the questions, nobody would have understood what am I saying. So that is why it was necessary for me to revise the areas in detail. Abid is saying, thank you, sir, for giving us time from your busy schedule. Thank you, Abid. You're most welcome. Anwar Karim is saying, so the PowerPoint presentation enough for the framework and the current issues? Yes, Abid, it is enough for the framework and the proposed framework. It is enough for the framework and for the proposed framework. It is not exactly enough for all of the current issues. but it is sufficient enough for the framework, the proposed framework, and the exposure draft relating to IFRS 3 and IFRS 11. The things that we have covered are covered in detail, but things that we have not covered are obviously there. You should be learning that at home, but obviously the major part of the current issues have been covered. Yes, Simran, it is possible to learn all current issues because they are already provided in the study texts. You can refer to that. Now let's read question 3 part A. The question says that Phil is a coal mining company and sells its coal on the spot and the future markets. On the spot market, the commodity is traded for immediate delivery, and on the forward market, the commodity is traded for future delivery. So we basically sign the contract today and we deliver the coal in the future. The inventory is divided into different grades of coal. One of the category included in the inventory at 30th November 2026 is a coal with a low carbon content, which is a low quality. So we have some coal with low carbon content, which is called low quality. Phil will not process this low quality coal until all of the other coal has been extracted from the mine, which is likely to be in 3 years' time. So approximately it will take us 3 years to complete the extraction of the coal other than this low quality one. Based on the market information, Phil has calculated that the 3-year forecast price of the coal will be 20% lower than the current spot price. Now, the directors of Phil would like advice on two matters: whether the conceptual framework affects the valuation of the inventory, and how to calculate the net realizable value of the coal inventory, including the low quality coal. So now basically we can say there are three questions. Does the framework talk about the valuation of inventories? The answer is yes. The framework has defined 4 different measurement bases, which includes the net realizable value, which applies onto IAS 2. And in the proposed framework, the models of measurement have reduced to 2: the historical cost and the current value, but the net realizable value is still included in the current value measurement model. So this is what we are going to write in part 1. And in part 2, we have to tell how do we calculate the net realizable value, and specifically how it is going to be calculated on the low quality coal. So there are 3 different parts which we can say. Now, if I refer to the requirement says advise the directors of Phil on how the above transactions should be dealt within the financial statements with reference to relevant IFRS standard and the conceptual framework and the proposed revision where indicated. So we have to write 3 different areas: relevant standard, the conceptual framework, which is the current conceptual framework, and the proposed revision. So we are going to talk about IAS2, we are going to talk about the framework, we are going to talk about the proposed framework in part A and part 3, part C. So let's start to write it down, and I am calling this December 2018 question number 3 part A by the name of Phil. So we are going to start with the first point where the question said whether the conceptual framework affects the valuation of the inventory. So we're going to say that the conceptual framework is basically the core concepts on which the accounting standards are built. So ideally, it should not be possible that any treatment in an IES is not there in the framework. So basically anything which is in the IES comes from the framework. So it is not ideally possible that the accounting treatment is designed without the framework. Now, in case of inventories, in case of valuation, the current framework has defined four different measurement methods, which are as follows. So we are going to write all four of them: historical cost, current cost, which is the fair value, and the present value, and the net realizable value. So IAS2 has adopted the method of net realizable value in valuing the inventory of an entity. With respect to the proposed framework, it has defined two broad measurement methods, which are as follows. So here we have again the historical cost and the current value. The current value basically includes all the current cost, present value, and the net realizable value. So effectively, the measurement of IS2 of net realizable value is covered under both the current framework and the proposed framework. So over here we have written the answer to the first point, that whether the conceptual framework affects the valuation of the inventory. Okay, so now let's write the answer to the second part, where the question says that how to calculate the net realizable value of coal inventory. So now we are writing the answer to part 2. The previous one was part 1. So we can say that when calculating the net realizable value, an entity should calculate the expected selling price less expected cost to sell. The original definition is expected selling price less expected cost to complete less expected cost to sell, but we are not writing expected cost to complete because we are only extracting the coal and we are not actually developing that. So that is why expected cost to complete was not relevant. So that is why we have not written it. Okay, the admin is asking about the feedback for today's session. So you have 2 minutes to provide the feedback quickly. Okay, thank you everyone for the feedback. Few students were saying that the break was too long of 15 minutes. Actually, the topic of framework and the current issues needs a lot to speak. So the 15 minutes break was not for you people, it was for me. Because continuously speaking basically exerts some pressure on the throat. So I had to take some rest, have some coffee to make it available for the next 1.5 hours. Okay, so let's continue now. Murtaza is saying, what's the impact of 3 years forecast price? Murtaza, we are moving towards that. So we are saying that when calculating the net realizable value, an entity should calculate the expected selling price less expected cost to sell. The expected selling price is the price which an entity expects to sell at, which normally is or which normally should be the fair value of the inventory, but the valuation will not be calculated as per IFRS 13 because it does not deals with the or it does not applies on IAS 2. So the company should use its own estimates using the market information to calculate the current value at which the company will be able to sell the inventory. So this is how basically we calculate the NRV. Because it does not applies on IS2. So we have said that the expected selling price is the price which an entity expects to sell at, which normally should be the fair value of the inventory, but the valuation will not be calculated as per IFRS 13 because it does not apply on IS2. So the company should use its own estimated value using the market information to calculate the current value at which the company will be able to sell the inventory. Simran is saying why it does not apply to IS2. Simran, this is something which is relating to IFRS 13. So now we are going to say that when calculating the value of the low quality coal, Phil should not be calculating the value at which it will be sold after 3 years because as per IAS 2 the NRV should be the current NRV. What Phil can do is to use the price of the future contracts because those are can also said to be the current price of the future deliveries. Similarly, Phil should try to assess that if all the other coal would not have been available, at what prices it would have sold the low quality coal at. That price can be said to be the expected selling price, which should be used in the valuation of the inventory. So this is how we have answered to the next part of the question, that how we are going to calculate the net realizable value and including the low quality coal. Murtaza is saying, so would take present value as current value rather than current spot price. Yes, we can take Murtaza the present value, but this is not the right way to calculate the future value first and then to calculate the present value first. It's better to remain in the present value and then calculate the value. Now we have 6 minutes left. Let's um, continue quickly with part C, because this is something which is sort of a repetition of the September attempt question as well. So the question says that Phil also jointly controls coal mines. Jointly control coal mines. This means, is this a joint venture or a joint operation? Jointly control coal mines. Is this a joint venture or a joint operation? Murtaza is saying joint operation. Abid is saying operation. Harsh is saying joint venture. Kate is saying joint operations. Okay, basically, yes, this is a joint operation. George and Simran is also saying operation, because coal mine is basically an asset. It is not a company. So Phil jointly control coal mines with other entities. So this is a case of joint operations. The Theta mine is owned by 4 participants. Phil owns 28%, and the other 3 participants each own 24% of the mine. So Phil has the highest percentage of 28 and the remaining 3 are having 24. The operating agreement requires any major decision to be approved by parties representing 72% of the interest in the mine. This means that, can Phil take the decision all alone? The answer is no. And this also means if Phil disagrees with the decision of all of the 3 other parties, they may also not be able to take the decision. So Phil is considering purchasing one of the participants' interest of 24%. So Phil is thinking to purchase the interest of one other party. So 28 plus 24 will become 52%. So will this become a subsidiary if we acquire further 24% shares? Will this company become a subsidiary for Phil if it acquires further 24%? Abid is saying yes, Harsh is saying no, Murtaza is saying no, Simran is saying yes. Okay, George is saying no. Basically, the answer is no, because according to the contract, 72% representation is required on all major decisions. This means that if Phil is able to acquire one more 24% shares, it is not still able to take the decision on its own. So that is not going to become a subsidiary, because it is not going to have a control. The directors of Phil wish advice on whether the proposed revision of the conceptual framework will affect the decision as to whether Phil controls the mine. So is the conceptual framework, the changes will affect this to be a subsidiary or not? Is the changes in the framework going to affect the subsidiary? Murtaza is saying no, Harsh is saying no. Yes, the answer is no, because the framework is not changing anything with respect to the business combination. The framework is changing the definitions. The framework is changing the recognition criterias. It is not affecting the business combination IFRS 3. So the definition of control will actually remain the same in before the revision and after the revision. Now, the question requirement says that the directors are also wondering whether the acquisition of the interest would be considered a business combination under IFRS. So, will this be considered as a business combination? The answer is no. So this is mainly something that belongs more towards the IFRS 3, more towards the definition of a business, more towards the control, more towards IFRS 11, and less towards the framework. So normally what happens that when students see the word framework, they say, oh, a 10 marks question was there from framework. But that is not the case. The 10 marks question is mainly relating to the joint arrangements and mainly relating to the consolidation. This is there is a some part of the conceptual framework and not the entire question relates to that. So in the exam, you have to understand the overall point of the examiner rather than just looking at a word framework and getting a heart attack that, oh my God, three different questions came from the framework and now what I'm going to do and I'm going to come back and failure and this and that. Don't think it that way. Try to find out the points which you know and try to cancel the points which you don't know and simply write what you can write. Okay, Yajna is asking any important technical articles to read. Yajna, it is preferable to read all of the technical articles because those are written by the ACCA's examination team to facilitate you people. So don't think are they important or not. They are important. Read every technical article because they can ask anything from over there. Okay, so now the time is going to up in 1 minute, and I know the management is going to send a message that the time's up. So before they send a message, let's wind it up. Thank you, everyone, and I hope the session was good enough for you people to increase your confidence, to increase the concepts, to increase your ability to perform in the exam. And there were a lot of questions during the lecture. I hope that was not disturbing the others. Most of the questions being asked by Murtaza and Simran. So Simran and Murtaza, you should be paying extra fees for the exam. Okay, so that was just a joke. Thank you everyone. Take care. Best of luck for the exam, and I will be waiting for the feedback after the paper and after the result that what actually resulted out from the sessions. So thank you everyone. Take care. Bye bye. Allah Hafiz.